reserve. So you have your savings bank accounts. Let me do some annotation. So you have your savings bank accounts. This is your original money, your own money. You have 100% control over that. If I want you to pay something in like one day, you can go to your bank and get it. You can sell some stuff. It's still personal, but it will take you maybe a couple of days. Your CDs, your collections, or something you can turn into cash. You can have your credit cards. It's not entirely under 100% of your control because there's a bank. So if the bank has a limit, you have a cap to spend on credit. And you can borrow from your family if you really need to pay something immediately tomorrow. But their family is your family, but like that's a 0% control over it. If they choose no, you don't have anything except cry. So that's short term. If you have some funds in your retirement funds, you can withdraw them in not maybe a couple of days, but maybe a week. Maybe you can sell your car for a fair price if you can wait for a week. You can lease, you can do mortgages, you can borrow friends. Again, this goes from personal to personal control, 100%, or 0% control. It's completely external. You can, if you have shares, maybe in a couple of months you can sell them. If you have a house, you can do a mortgage, but probably you don't have it. Your spouse has some control over it. You can get a personal loan as much as the bank gives you, so it's not like 100% under control. And you can get a mortgage. So these are the financial resources that every founder has to understand how much of them they have. And once you understand how much of these resources you have, you need to understand what is the maximum amount of risk you are willing to take for this startup. I see a lot of founders going into this very romantic Romeo and Juliet mode in terms of building partnerships, creating founding teams, without understanding that those partnerships and founding teams will burn when shit hits the fan, which is when you don't have the money to pay for something that's really critical, when you're starting to assume that the other partner will cover for some of the stuff, when you have a co-founder that is just not quitting their job and also not putting any money, but he wants to be a co-founder. So these things are unfortunately the #1 reason why startups fail. There is actually only one rule in the startup world. Does anybody have a guess what that rule is? You can write it on the chat. Can we see the chat? Yeah, I think we can see the chat. So what's the #1 thing you have to remember in the startup? What's the #1 thing? Actually, possibly one of the only things that will definitely kill you. No, risk everything. It won't kill you. Maybe you'll survive. That's okay. There's one thing: when it runs out, you're out. There's like no second life. You can't spawn. Yes, Siddharth has the right. When you run out of money, you're done. Your job as a startup is to find the quickest way to generate revenue so you don't die. There's actually only one rule. Oh, let me delete this. Oh, like, there's only one rule. You don't die. If you don't die, you'll succeed. What's the rule? You don't die, you succeed. How are you going to succeed? You don't die. How? You don't die. And if you don't die, you'll get lucky enough. If you have an understanding of how much money you're going to put into this company, how much each founder is going to put into this company, what do you need to do to make sure you are fulfilling the #1 rule? You are far ahead of most of the startups that we have seen with Burak. When we mentor teams, we ask these questions very brutally, and most of them do not have an answer. If they don't have an answer, it means they have no idea what they're doing. It means they're just romantic about an idea. They don't know who, they don't have a sense of urgency. So the #1 rule is you build a sense of emergency to keep your startup alive. Putting your own money is the sure way, but there's a limit. So that's why you might want to go to investors, but that's the wrong time to go to investors. One story that I really, really like is this company. So I'm going to leave you a few more, like I'll be talking, but you can read. We tried to raise $3 million from VCs. It didn't work out. They were not a startup that were profitable. They couldn't get anybody to invest. They were doing a video game company. Not many of the investors believed it. And this guy's name is Charles. So what they did, and of course, it's Guitar Hero, by the way, it's a secret. Him and his brother took a second mortgage on the houses they had with the permission of their spouses, because if the spouses have said no, then they wouldn't even have been able to get the mortgage. They took a debt to buy the inventory to put it on a retail store. And once they did that, the rest is history. They were this close to shutting things down because nobody gave them any money. Nobody wanted to finance the inventory. And they had already mortgages on their houses and already were out of money. And then they raised a small amount of money by debt. They bought the inventory, they put it on the retail store, they were sold out immediately with the cash. They bought more inventory, raised funding eventually, and then they become the Guitar Hero that we know today. It's one of the earliest success stories in the independent console gaming industry. So rule number one, don't run out of money. If you run out of money, you can't even do this. There's a limit. I'm not going to go through how I failed to manage this relationship with my partners and how we ended up not talking to each other for the last 10 years. But that's a different story. So rule number one, do not lose sight of how much you have, how much you are willing to risk, and how much each founder knows what the other founders are willing to risk. This is not a conversation to do when you are running out of money. This is a conversation you need to do before you start dedicating a significant amount of your time and life into the startup. So going towards that, now let me give you some fundraising realities. This is biased. This is based on a research that's done in the US. So of course, it's very different in Amsterdam. It's very different in Kenya. It's very different in Nigeria. It's very different in Laos. Very different in Jakarta. Very different in Istanbul. But the mentality still holds. What is that mentality? I'm going to go through it. You need to build the purpose before you build the pitch and before you actually start raising funds. What do I mean by that? Your purpose of fundraising has to be something of urgency, but not urgency of you're losing money and you are running out of money, but urgency of catching a big wave of a market shift. If you have the purpose to catch a wave, if you have the purpose to catch a market, if you're at the right time, if you have the purpose to scale, then you can fundraise. If you are very early stage, if you don't have a product, if you don't have customers, if you don't have full-time founders, if you're doing this on the side, you don't have a purpose to fundraise. Your purpose is just, oh, I don't have money, I want somebody else to give me money, and that's not a purpose. The only two valid things that will help you fundraise to build a purpose is, this is a very hot market. I need to scale right now. That's the only two things that is the right purpose to fundraise. If you are doing a research, like R&D, like real discovery phase research, deep tech, you can have a purpose of, I want to prove that this technology works, so I need to invest a lot of money up front, but there's a big market and there is a good demand and we can deliver the product. So deep tech, high tech, not just an IoT sensor builder platform, but real deep tech research-based startups might have a secondary, might have a valid purpose of fundraising only when there is a market need that's validated and that needs the product to come up. And there's a 10x multiplier on the impact of that product. So it's very, it's different. Healthcare, bio, pharma, those products are aligned with that purpose. Once you have that purpose, you build the pitch. You don't build the pitch without the purpose. You build the pitch with the purpose. And that's why the pitch starts with what you have done to justify that purpose. So the basic story is, hey, my name is Ozan. We're building this because we know everybody needs this. And how do we know this? We have this many customers growing 20% month over month, this many users paying us this much amount of money for the product that we build in under 6 months. If there was not such a big demand, if there was not such a high potential in the market, nobody would have bought us. We figured something out that many other people have not yet. So we need the money to capture the rest of the market. That's good. That's the pitch. You start building the pitch once you have the purpose. And once you build the pitch, starting with traction, starting with team, starting with the target market, then you can go to the process of fundraising. I see most of the startups do the reverse. They do the process and then they start to tweak their pitch and they try to build a purpose around it. That's when startups fail. But they don't usually fail in fundraising. They fail at creating a value for their company at an exit. What do I mean by that? So if I hear one of your pitch, one of the team's pitch, and if I tell you, I really like your idea, I like the team, I want to invest. And if you say, okay, yes, great, let's start talking, you are in loss. I will drive the process without you figuring out the purpose and the pitch. And if that's the case, I will get what I want from you with the least possible amount of money and the most possible amount of control. The process of fundraising is not talking to whoever wants to talk to you. The process of fundraising is all about bringing competition into your opportunity and helping the VCs navigate through the difficulties in investing in you and finding lead investors and leading them the way you want to lead them, getting the most out of them, giving the minimum control. Control and loss, control and valuation are like a seesaw. Usually, if you are getting a higher valuation, especially in early stages, you're leaving control. If you're trying to keep control, you're probably accepting a lower valuation. Control means how you are going to control the board of the company. It's not the majority share that controls a company. It's the board that controls the company. And you will see this dilemma in early stage companies where investors want to take a board seat by just 5%, 10% of the company, whereas some investors don't even attempt to ask for it when they have less than 10%. Control is important because control determines how long will you be in your company and how wealthy you will become at the end of the process. How fast you're going to go, if you will be kicked out of your company or not, those are all related to control. And valuations and everything else related to economic benefits. Who will get what at an event of an exit? Economic stuff is wealth, is mostly driven towards who will get what at the exit. Control side is about the board, who controls the board and makes key decisions. Not necessarily economic value. Of course, it relates to economic value, but not necessarily something that increases or decreases economic value. Those are two different things, and they're usually in contradiction. The sad part in our region, in most of the countries I mentioned a second ago, is we don't have this luxury to get to 60 meetings with investors, finding 40 of them being remotely interested, and talking with 20 of them to have a conversation on investments and maybe having 5 or 10 of them being interested in investing in us. But usually this is the dilemma, this is the flow a typical serious seed stage startup in US goes through. They go through 60 investor introductions, 40 response and they have initial meetings, 20 of them gets into different discussions and detailed discussions, 5 to 10 of them starts being interested and you close it with 1 or 2 investors. So I am going to ask you a question and let me see if I can create a poll, but I can't create a poll. So on the chat, we can do that. Let's say you have, and by the way, for your Q&A, please use the Q&A because we're not looking to chat while doing this and we can get lost. So let me ask the question here as well. How many minutes do investors spend on a deck that is sent to them via email at seed stage? So we have 2. Let me ask the question, how many minutes do investors spend on a deck that is sent to them via email? Like a 20 to 30 slide deck. 20 seconds, 5 minutes, 30 seconds. 0, well, usually not 0. 0 means they're not investors. An investor has to spend time on the decks that's sent to them, otherwise they're not doing their jobs. Some of them are more arrogant, but yeah, unless they're spending anything less than a minute, it means they're just not good enough investors. 10 minutes is the max. 1 minute tops, says Chris. Okay, so I think this group is like realistic. At least they're not delusional. 1 to 5. So Utam is tries to get this right with giving the brackets, but Utam and many others have been proven right. So 3 minutes, 44 seconds. On average, this is going to hurt this, I mean, in a way. This is the time spent on decks that eventually got funded. So most of you were in the right framework. This is the deck that somebody read and financed at the end, not the ones who didn't get financing. So this is important for you to remember. 344 makes you happy. Yeah, it should make you happy, but it should make you concerned as well. Why? Because if I'm going to only spend 3 minutes, 44 seconds on the deck, where do you think I will start looking into? Give me the top 3 slides that I will, as an investor, I will spend the most time with. So what are the traction, team, okay, revenue, value proposition, traction, market size, team, track. Pick one. Uche is trying to say, target my traction, team, traction, market. Good. Financials and traction. So Brian is almost on the spot. Scalability, not a thing. Team problem, nah. Company status, nah, not really. Founders, licenses, nope. Problem solution team, nope. We have a few winners, and I'll actually show you. Market, no. No. Profitability potential, no. Product market fit, no. I mean, if there's product market fit, you probably have it in the numbers. What's in it for me? The investors. Yes. Business model? Absolutely not. Timing? Not really. Scaling? Not really. Scaling discussion comes when you have a big market anyways. Go-to-market strategy and everything else comes. Innovation? Juan Andreu, I hope you were right, but absolutely not. Innovation does not concern the least any of the investors. Invention potential IP for some investors, some investors that are investing in deep tech, maybe. Exit strategy, absolutely not. This is the seed stage. If you start talking about an exit strategy in seed stage, you don't know what you're doing. How much am I paying for how much of the company? And that's not a conversation that happens in the slide deck, but there's a tangent to it. paid up capital by founders, not on the deck. So I'm talking about the deck. And let me share what's going to hurt you. The company, the investors that spend the most time is the financials, the team, and the competition. This is important, and this is not just the market size. I mean, pay attention, like the market size is somewhere else. And most of you said problem solution. So problem solution is how you start the slides, but it's not the most important slide that the investors look, because the investors have looked into multiple slides, multiple companies. They probably know whenever you mean a problem and solution, they just skip. They want to see how you are going to get to that. And financials in that sense, revenue, customer acquisition cost, traction, those are the financials, not what you will be achieving in 3 years. Then the team, they spend the most time trying to figure out, has this company done enough for me to be interested? Validation. Is this team believable enough to beat that odds, to increase that traction? And do they have anybody that they cannot beat because they have so much resources? They got recently fundraised. There's nothing else. What's the unique proposition for that company? So they look into those, and then they look into company why now and company purpose. So what do you want to get out of this after you succeed in your seed round? Why is this the right time to actually pull this off? They want to know your perspective. And that's usually how the discussion starts in the term sheet anyways. So in terms of time, let's say you got all this right and somebody was interested, they gave you a term sheet, or you are just start the process. If you are going to be successful in fundraising, and this is the average time spent to close deals, it is very difficult for you to close a deal in under 15 weeks, which is almost 3.5, 4 months. It's usually very rare for companies to close it in the 1 to 5 weeks. Once you start the process and once you have a term sheet and you signed it, it's really difficult. And usually it takes about 10 to 15 weeks, 8 to 15 weeks. So minimum 2 months, up to 4 months, up to 3.5, 4 months. So if you do not have that time scale in your mind, you do not know what you're doing. You should be perfectly comfortable in understanding this is going to take time. This is going to take a lot of the time for at least one founder. So that one founder will not be able to do anything else but run the process of fundraising. Talk to investors, talk to lawyers, try to get competition, updates the data room, manages the flow, manages questions from investors, does many more pitches. So when you are like 3 founders or 2 founders and you want to raise serious funding, that one founder is lost for 3 to 4 months. And it's really difficult for the team to manage with already limited resources, with already limited exposure and already limited time. One thing that I see founders not understanding fully is how much time consuming this is. And I'm not talking about you need to pitch to 60 investors and it's going to take 1 hour each, so you're going to deliver this in like 3 days. No, the process takes forever. If you're not ready to fundraise, if you're not ready to dedicate one founder to raise this amount of money, you are not ready to fundraise. It's different with accelerators, but we don't call fundraising from accelerators or getting accepted into accelerators as a fundraising process. You fundraise at the end of the process. You try to get in, but it's just an application and a couple of interviews. And if you get in, you get in. That's why at seed stage, your best chances of fundraising or achieving funding resources is through accelerators. Yes, I mean, I'm going to share this document with you. It's a document tracked by DocSend. So Tom Eisenman tracked 200 companies that raised cumulative $360 million. And DocSend, for those who don't know DocSend, it's a document sharing platform tool. When you send your document through DocSend, not in an email attachment, DocSend gives you reports on how many minutes, who opened it, how much time they spent it, where did they spend the time, where did they spend the most time, how much did it took them to close deals, etc., etc. So DocSend is a tool that does that. If you haven't used it, use it. It works. Some investors don't like it, but most are okay with that. So yes, as I told you before, and this is a very short summary, this research is biased. It has a survival bias, it has a geography bias, it has time bias. These companies might be raising in that's like boost periods or in down periods, so it changes all the timing, all the amounts, sometimes in a good way, sometimes in a bad way. But regardless of crisis, regardless of pandemic, VCs are out there to invest. Valuations for some companies have gone up, not down. Some sectors are completely out of investmentable range at the moment. If you're doing a travel tech company, that's not the right time to do it. If you're doing a communications tech company, yeah, Edtech, yes. But other than that, everything is still getting investments. Some regions have seen a lot of fall, but once a VC raises the funds, they need to deploy it. So it's not like a world where they can hold on to the money and they become richer. Their job is to invest that money. So if you're doing something that's relevant, if you have good traction, great mechanics and growth rate and sustainable, well-placed, experienced team, you can still fundraise. Yeah, I mean, that's more or less what I wanted to talk about. In the document that I'll send you, you'll see some links to decks that were used. If you are preparing a deck, you will have multiple good resources to get that done. And with that, I'm just going to open for Q&A.
Perfect. Do you hear me, Ozan?
Yes.
I will also open my video if I can find it. All right.
Yeah, we can see you. The video's up.
All right, perfect.
So one question Sharif has asked, is there a valuation method early stage startups with financial models? No. I mean, yes and no. So I'm a financial professional. I'm a CPA, a certified public accountant, actually. That's how I started my career. I was in Deloitte. I did a lot of work in, not in investment deals, but in like auditing and consultancy. Some corporate finance deals, but mostly audit. There are methods that you can use to try to value your company. But imagine this like at very early stages without any revenue, there is not much that will hold water. Usually what happens is the only benchmark, the only thing that will get you a good valuation or some valuation, not even a good one, is the benchmarks. Who else doing a similar thing in a similar geography, in a similar market was invested by? If nobody has been invested in your region doing a similar thing, go to nearby regions. Don't go to San Francisco to benchmark valuations. That's ridiculous. I lived there for 3 years. That's not even on this planet. You think you can fly there with the Turkish Airlines SFO, Istanbul SFO TK79? It actually does not work. You may be flying there, but it's a different planet. It's equally to get a rocket ship to Mars. So the valuations don't make any sense in there. Competition determines the early stage valuation. So your job is to prove you have traction before you go in front of the investors. Do whatever it takes to prove traction. Because if you have traction, if you have revenue, you don't need investors to survive. You have to go to the investors when you don't need the money to survive. If you go to investors when you need the money to survive, you will take whatever investors give you, and you're not going to like what they give you, and you're not going to be liking the work you're going to be doing, because at the end, they're going to get the upside. You're not going to get anything out. So get traction. And at very, very early stages, a rule of thumb in US is if you have one engineer, you're $500,000 worth, total valuation. If you have two engineers, you're $1 million worth. If you have three engineers, you have $1.5 million worth. The reason being, engineers, good engineers in Silicon Valley get about $500,000 revenue with stock options and everything else per year. So if you have three engineers, that's how much it's worth. So if your engineers are getting way less paid in Pakistan, in Amsterdam, in Istanbul, in Jakarta, in Doha, in Lagos, multiply the amount of a good engineer salary by 3 if you have 3 engineers. That's the max that you can expect before revenue. If you have revenue, that's a different story. Can you raise funds for charity work? No, but you can raise investment, impact investment, but not for charity work. Charity is giving. If you're meaning, I'm going to, like a Robinhood, if you're going to get money from here, give it away, that's charity. Nobody gives money to that. That's donations, zakat. In Turkey, in the Muslim world, that's what we call it. Or like donations, charity, like giveaways, whatever. But if you are building a business model that has revenue generating potential, then yes, there are impact investors who equally value market returns and social impact. That's what I did many years. So I would like to talk about it. If you have a charity work, I wouldn't like to spend time with that, sorry. But if you are doing impact work, you got my attention. One founder at seed stage is favorable, or 3 founders together. One founder does not go anywhere, usually. Of course, there are different cases, and every one of you can name one founder company that you think is very successful. Every one company that you can name that's successful, I can name you 10 that failed. So like survival bias is not favorable to one founder teams. Unfortunately, that's very true in investing, because if the founder is gone, there's nobody I can get my money back from. And by that, I don't mean I'm going to get the money from the company. There is nobody that will work as passionately as the founder. And if something happens to the founder, life happens, then that company is not going to go anywhere. And my money will not going to give me any returns. That is a very, very significant risk. But on the other hand, a founder alone is really vulnerable. This is difficult. If you're the only founder waking up every morning, 7/24, 365, and nobody's there to help you when you fall, and you will fall, it's really risky. Mentally, it's really tough. Usually, you need somebody to pick you up. So that's why investors focus on teams that have at least 2 founders. They don't have to be 50-50 founders, but there's actually somebody else I can rely on if I fall. Will you help Stars to introduce some local investors in Turkey? Do you have traction? Are you doing something that's scalable? Does anybody in Turkey relates to whatever you're doing? If so, yes. My great team, good records keeping. How are you doing? License required. Are you anywhere going to get one? So if you have traction, if you have a great team, and all you need is licensing, you will find people interested. My suggestion to you is find a company that has the licensing, try to partner with them, share their license in a way. You may be giving away some part of the company, some part of the revenue, but maybe if they're above the line, you're below the line, they might be okay with that. Or if there is a company that failed, although they had the license, go talk to them, like take them over. And then these cases happen. It's really difficult with fintech. I'm assuming this is a fintech company. Yeah, it's a financial regulator. So go talk to sandbox operators. Go talk to banks. You can make a partnership with a bank that you see as a competitor, And maybe they might want to work out with you. Work with accelerators that have partnerships with banks. Find some overarching umbrella entity that will help you get the license. Go talk to the licensing operator. Nudge them, bug them, ask them for private sandboxing. So you can get there. Since you said you have a great team, that's what's going to differentiate you. If you have a great team, you'll figure the licensing out. You'll borrow money just to get the licensing. If you believe in that's, remember the first slide. Actually, let me open that up. Remember the first slide. If you believe in this opportunity, you will find money or partners. How can you calculate convert social impact from? Ooh, that's really good. Bambang, I have a full lesson only on the impact measurement. So any advice for solo founders? Don't do it. How does being incorporated help with funding? Are there downsides? Nah, I mean, if you're not incorporated, you can't get funding. This is not like the Google story is just ridiculous. Somebody gave them a check and they need to go to the bank, but before they go to the bank, they need to register the company because the guy wrote a Google Inc. because when they wrote it, there was no Google Inc. Those are mythological. That's true. Like technically it's true, but just doesn't work in this part of the world. Yeah, so the travel event startup. Well, God give you patience. Pre-code, great growth. Yeah, Gurmej, I wish you the patience and good luck. But it's interesting. So I said travel and event startups are like doomed. But if you were able to switch to a different business model that works virtually as well as offline, you might have a chance. So I'm consulting a company, actually. I'm like a board member, advisor board member. They were doing things online. They were doing things offline. Then they switched to a completely online model. Now the wave is kind of a little bit fuzzy, but came back. They have two different business models now. One was going down, so they used virtual to pick it up. They didn't go bankrupt. And now they're using the virtual one to go after the competition. So there might be some cases where this is to your favor. A lot of the independent booking agencies that have curated opportunities still are making money, but mass travel events, that's really difficult. Turkey has plans to attract foreign startups. How to get information? I think Turkey Investment Agency has something, but we don't have anything. Burak is smiling cynically. I'm just gonna, don't let me curse on a recorded session on how much we failed in getting foreign startups.
Why do you want, I mean, of course we are, all startups are welcome to Turkey, and we will be happy to help all of the entrepreneurs who wants to be in Istanbul or any city in Turkey. But the reason, if you share the reason why do you wanted to come to Turkey, it should be also helpful for us to help you how. So I think if you send us an email, we should be talking.
Yeah,
about,
I mean, if you want to live in Turkey, always come and live, that's okay. But I don't think the Turkish, while you are in Turkey, you can't make enough money by selling in Turkish shares and converted to dollars. I like one question Emmanuel has. What's one advice you would give an Edtech startup competing with Google? If you think you're competing with Google, you don't need my advice. But I don't think you're competing with Google. Google doesn't know shit about you. And Google is not something you compete with. You can try to replace a version of what they are not able to do, but that's not competition. That's never a fair competition. And yeah, don't compete with Google. It may be the same product. If you're trying to create Gmail, don't do it. If you're trying to replace Google for schools, there are things that you can actually beat Google to it, but don't worry about Google. Just focus on what the market needs. Focus on what Google is not able to provide to your customers. Google is not going to be there with people. Google is not going to take care of customization. Google is not going to delight these people wherever you are. Google is in a very different zone with different metrics. It's in a different planet. Don't worry about it. And if you're really good about it, then Google will come and buy you up.
So last question, Ozan.
Yeah, traction, paying clients, work alone, get freelancers up. That's okay. It's perfect. Set up a team with the right skills and experience and go hire someone as an employee at them. Of course, like if you're having like, it's yeah, sure. Like if one employee will give you more revenues, hire the employee. If you're fine with freelancers, just keep going with freelancers as much as they break, until they break, which some freelancers are actually like working on a tight schedule and they work a lot. Burak and I had been using freelancers for multiple things that we're building. But I like to have a good relationship with people I work with, but like what I'm building is very different. But like if you're going to get an employee to work them full time, understand the difference between managing the people and leading the people. If you're looking for somebody to manage, low cost, high reporting ability, and lots of like tracking. If you want to lead people, don't. So what this is really interesting to take out, like maybe the last thing. If you're struggling to set up a team, it means you're not able to convince people to work with you. That's lack of leadership, not from a like you can't get things done perspective, but you're not able to influence people. That is a question I would have. I'm not saying like you're not a good leader. I mean, I don't know you, but that's investors need to make short answers to questions that will take ages to figure out. But if you're telling me you have great team, so you have great traction, good market, and nobody is working with you, there's something wrong. You might want to work on that. So I hope this was helpful.
Ozan,
it was really short, really quick.
it was very cool. And I think there was great questions.
Yeah, I like the questions.
Ozan, it is the first with Ozan in this program, so Ozan will be always here. You can send me an email if you have more questions about today's webinar as well. And tomorrow there is Brett Feld, so we will be here. It will be a fireside chat. It won't be a webinar, but you will be able to ask him any questions, especially his, please check his last book about the ecosystems, different parts of the world, entrepreneurship ecosystems, and also read the venture deals. This is one of the guidebooks where all the startups and entrepreneurs should be know about how to contact with investors and make negotiation with investors on the term sheets and details of the agreement. I strongly advise you to read it. And Ozan, thank you very much for the
You're welcome.
This night, and we are very happy. This is the first meeting, and hope to see you in other meetings. Have a great day. Stay safe and healthy where you are.
Take good care, guys. Great questions, great energy. Good luck, Godspeed. And Karnati, please reach out to me. I'm interested in what your problem was. Okay, 6-8 hours of meditation.
Thank you very much. Bye-bye.